Peter, it's great to see you again. It's been some time. Would love to start off with your current macro take as it relates to the global economy, financial markets. What do you feel is most germane at this time?
Yeah, no, great to be here. Well, looking at the U.S., we know that data center construction is a big driver of economic activity. I've seen stats that in the first 3 quarters of 2025, the contribution all in, so everyone from the chip company down to the cement pourer, you're talking about 45% of the incremental growth related to this. Then you have strong consumer spending on the upper income side, and then you have a $2 trillion budget deficit that spills over into the private economy. So those are the main drivers of growth. And then you have weakness elsewhere, still frozen U.S. housing market, manufacturing that is still not seeing much growth, but hopes that maybe we're on the cusp of some inventory rebound, but that remains to be seen. And then low to middle income consumers are still pretty financially stressed. And globally, it's somewhat mixed too. We take the Chinese economy. We know that consumer spending has been sluggish as they are now in, I don't know, fourth year of the downturn in the housing market. But on the other hand, they're killing it in some areas of manufacturing, like EV, solars, industrial automation, robotics, um, and other forms of electrification that they seem to be doing well with. And even in Europe, Germany and France not seeing much growth, but Spain and Greece that are seeing pretty decent growth. Even Italy is seeing decent growth. So overall, a mixed picture. And I think that's what we've seen with the stock market over the last couple of years is a mixed picture. But the interesting thing about the market is the AI stocks are, or the hyperscaler stocks are slowing down in terms of their rate of change to the upside, and other things are now sort of joining the bull market party.
Noted. Could you unpack some of those topics that you feel are most germane per se? Could you just unpack that, especially as it relates to kind of this K-shaped economy that we hear so much about?
Well, I mentioned the consumer. The upper income consumer is doing just fine, and the lower to middle income consumer is much more value seeking, price conscious, and watching every penny. So if you're in the business of selling to them, you got to make sure you have the right products at the right price. Uh, I know everyone likes to throw out the K shape, and it's a good description of the state of the consumer. Lowercase I is another one that I heard someone use, where the dot is that upper income consumer, and the lower part of the letter is everybody else.
Noted. Okay, so as it relates to this new Fed chair that we have, obviously he has yet to be voted in, et cetera. Could you perhaps share your thoughts on him? And I'm also hearing quite a bit about yield curve control and things of that nature. And I'm kind of curious to if you could situate us as it relates to your thoughts on that.
Well, I mean, the guy's not even in the seat yet, and I'm hearing the nonsense about yield curve control. What's the point of yield curve control when the 10 years at 420? It doesn't make any sense. Something like that comes into focus if the 10 years at 6, not at 4. So I don't know where people are grabbing onto that. Kevin Warsh is not someone who, based on his tenure as a governor and everything that he's said since, he's not a fan of hugely manipulating the treasury market and the yield curve. So yield curve control is the ultimate manipulation. So I don't know where that came from. I think he is obviously going to cut interest rates because that's what Trump wants him to do. I do think he's not going to be shrinking the balance sheet, but I do think he'll be more judicious in using it, and only will tap it when there's some sort of economic emergency, not just to use it for the sake of using it. So I think that while he's branded as a hawk and his history shows that he somewhat is, I still think that he'll manage the situation as it comes, but with the idea that the less of a Fed footprint in the market, the better.
Noted. And perhaps some other things that we could be seeing coming down the pipeline. I know you mentioned kind of your overall thesis earlier on. Obviously, we have the midterm elections coming up. Could you perhaps share how that might impact the markets and so on and so forth?
I don't think the midterms are going to have much of an effect on the markets, even if Congress flips. Congress flips, there'll just be impeachment hearings for 2 years. From an economic policy perspective, I think the one big beautiful bill was what it will be in place for a while, and we're not going to see any changes. So, in terms of importance of legislation, I think the administration got what they wanted. So, I don't think the markets are going to really um, be influenced one way or the other based on what will happen in November, even though, of course, what will happen in November will be plenty of fodder. I think more importantly is what the Supreme Court is going to announce with tariffs and whether the Trump's use of IEPA is constitutional or not. To me, that's the most important thing uh, politically that the markets will have to deal with this year.
Could you unpack that a bit as it relates to the tariffs? I know it's kind of a vague question, but just if you could get more granular. Yeah.
Can he use tariffs in a scattershot approach, and as he's done, or does the law limit him to certain uses of it in terms of the sections that he can use and the purposes for them? That's what this comes down to. Um, I'm of the belief that you know tariffing bananas is not due to some national emergency because we're not going to make bananas here. um, Tariffing T-shirts is not a national emergency that we need to address because we're not going to start making T-shirts here. So it will be interesting to see how the court rules.
No doubt. And there's obviously a lot of volatility occurring in the markets, obviously. And as it relates to also a lot of geopolitical uncertainty for that matter, you hear a lot about capital rotating different parts of the world, emerging markets. Could you share your thoughts on that?
So it really started in 2024, but really accelerated in 2025, where international markets were very well bid and had a tremendous year of outperformance relative to the US after many years of underperformance. And that was way overdue, considering how big the US market got as a percent of global GDP, for obvious reasons because of the dominance of US technology. But whether it was the DeepSeek news in late January last year or the tariffs, it really got investors um, to widen the scope of opportunities in which they were looking at. And international markets got very cheap, unloved, and it was sort of easy pickings for investors if they were going to own less of the Mag 7 train, for example. And I do think that that trend does have legs. It's continued year to date, and I think it can continue because I think most important aspect of the U.S. stock market, in my opinion, is that the Mag 7 trade is over in terms of it rallying as a group and having the same level of performance. A lot of these stocks, a lot of these businesses are becoming hugely capital heavy. Free cash flows are shrinking across the board because of the enormity of the capex. And I think they need to be judged differently. Their top line revenue generating businesses are still pretty solid, but if that doesn't all fall to the bottom line, both earnings and free cash flow, well, then you have to price these companies differently. And because of the hugeness of their market caps, I do think that that has major implications for other things. At least right now, investors have found other things to buy, like international, like small caps, like mid cap stocks. I think it's great environment for active managers, and we are a combination of index but also active. So we're really enjoying this environment right now.
No doubt. As it relates to some of the geopolitical, and obviously we're mainly focused on, of course, on the financial markets, but obviously with geopolitical implications impacting everything, are there other things out there that you are tracking that are on your radar, so to speak?
The other thing on my radar outside of the sustainability of the AI tech trade is this still elevated level of long term interest rates around the world, particularly in Japan, Europe, and even the US. Now, the US 10 year is sort of just chopping around, has been for a while, but it's not going down after 175 basis points of Fed rate cuts. We've seen this move higher in JGB yields. The 2-year yield is at a 30-year high as of today, a 30-year high. Uh, the ECB has cut its deposit rate by 200 basis points, and the German 30-year Bund yield last week rose to a 15-year high. So to me, that's another thing that I'm watching. Debts and deficits now matter. The markets are telling you that, and that's another big thing on my radar.
And then I also wanted to touch on Main Street. Obviously, Wall Street has been doing quite well overall. What are perhaps some other things? I mean, obviously, credit card debt, we're seeing an explosion of that. But pertaining to just this kind of bifurcation, if you will, could you unpack other trends and things that you're following that are just kind of indicators, if you will?
Well, it's clear that inflation is the economic pain point for a lot of people. And we clearly know why, because wages, at best, for some, have only kept up with inflation, and for many, have lagged. So until wages continuously run faster than inflation, consumers are still going to be stressed. And housing is really the biggest inflationary pain point, both in terms of the first-time homebuyer wanting to buy a house, even with this drop in mortgage rates from 7 to 6. It's still very elevated, and home prices, while they're flattening out, which is a good thing, are still up 50% over the past 5 years. And then on the rental side, a good thing that rental price gains have slowed, because we need to make living with a roof over one's head more affordable. But I'm worried that after this deceleration in rents, that by the end of this year and into next year, they're going to resume higher again, as a lot of the supply, particularly in the Sunbelt states that came online in 2025, gets absorbed. So I think we're in a period of elevated inflation volatility. Inflation can slow for the next quarter or two because of rents, but I do think we'll get a pickup thereafter. And on the good side, prices are resuming an upward climb after a period of disinflation. So that's a thing that I think is really a key thing that we need to get into control, and that gets to the Fed and what Kevin Warsh will do. I know people think he should just cut rates because the labor market has softened and the pace of hiring has slowed dramatically, which I agree with. The demand for labor has slowed. But I think that if inflation is the main pain point, not just for the consumer, but on the business side, because of tariffs, raising cost pressures, and other commodity cost pressures and labor cost pressures, that that's the reason why we've seen a slowdown in hiring. So you need to address, to me, inflation is the disease. The slowdown in hiring is the symptom. So I think that the next Fed chair needs to be careful with his focus on cutting rates just to try to address the labor market, because then it risks flaring up inflation again.
No doubt. And if I might ask you, kind of off script, if you will, as it relate, even outside of the financial markets, I feel like obviously so much is changing, especially as it relates to automation, and a lot of concern of displacement going on, and to continue going on, if you will. Could you share perhaps your, any personal thoughts you might have as it relates to where you kind of see, I guess, society, and of course tying in with the financial markets and so on and so forth, given this technological revolution that is going on? I just would love to hear your kind of candid take on that.
Well, we have the history of the world as evidence that technology um, helps society to progress. But at the same time, it's highly disruptive for certain industries. It was disruptive for the buggy and the whip, and it was disruptive for the radio, and it was disruptive to people that made typewriters and film cameras. So that's just the history of the world, and this will be disruptive also. I mean, at the end of the day, AI software, and it helps us do things in a much more facilitated way and increase our productivity levels. And this is going to be more of the same. And there are going to be jobs that are going to be no longer useful. But I remain hopeful that technology, just as it has, will create new jobs that we're not thinking about. And this will be the case as well. Again, I don't want to downplay those that are going to be affected by this, but I think at the end of the day, we're all going to be much better off for it.
No doubt. Are you seeing you're closer than to the source than I am per se, but are you seeing a lot of change go on in the wealth management world, and as it relates to those working on Wall Street and leveraging this tech? I presume there's a lot of change in the works.
I mean, I think that, yeah, we're beginning to see it. Workflows you can condense. You can quickly summarize a meeting into a note in 10 seconds. Uh, it's not helping create portfolios because it's not necessarily predictive right now. But again, software makes us more efficient. It saves us time. It allows us to do things quicker, and certainly on the search side, it's essentially an enhanced Google search. So allows us who doing research like myself to access information a lot quicker. And but there's also pitfalls and making sure the data is accurate and and so forth. But overall, I think everyone should be smart about integrating it. But I think it still should be overall good and an incremental step, even though maybe a larger incremental step, because AI is not new. This is just the current iteration of AI, and but impressive nonetheless.
No doubt, no doubt. Peter, is there anything else that you'd like to share? And then also, how can people learn more about you and get in touch with you?
So I write daily on Substack. It's called the Book Report, and anybody interested in reading what I have to write can check it out and trial it. And then on the wealth management side, our website's onepointbfg.com, and they can learn more about our wealth management services.
Peter, I appreciate your time and hope to have you on sometime later this year. And I thank you again for sharing your thoughts.
Okay, thanks for having me.
Thanks for tuning in. And if you enjoyed the show, I encourage you to like, share, and follow if you found value in it. And I always look forward to hearing your feedback and thoughts. And until next time, take care and be well.